My guest now is Michael Hasenstab. He is the Senior Vice President and Portfolio Manager at Franklin Templeton Services. Michael was named Fixed Income Manager of the Year for 2010 by Morningstar. Michael, good to have you with us on Bloomberg. So what are you going to be listening for, or what do you want to know from this G7 conference call?
Well, I think we're looking to see, is it unilateral intervention or is it multilateral action? As your previous guest was talking about, if it's unilateral, it tends to have less of a lasting effect. The most effective multilateral intervention was back in the Plaza Accord, where there was a meaningful change in the value of the yen. But I think there's a couple factors at play here that are important to understand. A lot of market participants are looking at what happened to the yen post-Kobe earthquake in '95, and you saw the yen go from 100 to 80 initially and then weaken thereafter. But there are several conditions that are very different today. The yen is starting at 80, not 100. Additionally, the resources that are being brought back from offshore onto Japan to deal with the rebuilding, a lot of those assets are already hedged, so there isn't the same currency impact that we saw a little over 10 years ago. So I think some very different situations, and a lot of, frankly, the recent move, I think, has been more speculative versus substantive.
Michael, do you believe that we're going to see an increase in commodity prices? If we see more yen being printed, more money coming into the system, it's going to be at very low interest rates. People can borrow it, and then they can go and speculate using it on things like commodities.
I think we're already seeing the effects of the U.S., Europe, and Japan, even before this horrible crisis, have been printing massive amounts of money, and I think that has been partially responsible for driving up commodity prices. Additionally, you've seen a recovery in global economic activity, which we would expect to continue. That will put some pressure there. You have a very short-term effect, the supply chain disruption, which could put some upward pressure on prices. But again, that is probably likely to be a little bit more temporary until the rebuilding can get underway.
Michael, just if you can, separate the disaster that has befallen Japan to the value of the yen. What would the yen be doing without the earthquake and the ensuing damage from the tsunami and the nuclear reactor problems?
I think it's very hard to separate those out. But before the crisis in Japan, we think the yen was on a long-term trend to weaken as a result of very loose monetary policy in Japan, and the likelihood that that monetary policy remained looser in Japan than it would in the U.S. Now, the recent events, I think, will require Japanese policymakers to be even more aggressive than they were before in terms of providing a lot of liquidity, and that should further drive that trend over time for a weaker yen. You have a lot of very temporary distortions because of speculative activity, because of flow of funds and repatriation and risk aversion that are distorting things in the very short term. But I think if we look beyond that, you'll likely see a gradual depreciation of the yen.
Michael, what does the current situation in Japan and the potential for the Bank of Japan to sell the yen, what does that mean for U.S. interest rates?
I don't think it's going to be the primary driver of what happens to U.S. interest rates. I think the strength of U.S. Treasuries recently was on a risk aversion in response to the events that happened in Japan. I think there is a primary concern about the radiation issues at this point. Presuming that those are able to be contained and we can move towards a rebuilding phase, I think you would see U.S. interest rates return to the trajectory that they were on before the crisis, which would be higher, consistent with continued recovery of economic activity and consistent with the large fiscal deficits that the U.S. is running.
I want to thank you very much, Michael Hasenstab of Franklin Templeton Financial Services.